Welcome back to Gold Rush Reporter, where we cut through the noise and look at precious metals the way analysts actually do, with structure, evidence, and a willingness to question the comfortable story. Today, we're not talking about a rally, a headline, or a feel-good narrative. We're talking about a warning from one of the most established precious metal firms in the world, Heraeus. And before you get excited or dismissive, understand this. Warnings from companies like this are rarely dramatic. They're usually grounded in supply chains, demand mechanics, and historical patterns. That makes them worth dissecting, even when the conclusions challenge the bullish crowd. Here's the hook. Heraeus is saying the precious metal market could soften in early 2026, and silver may struggle more than gold. If that sounds like a bearish takeaway, you're only seeing half the picture. A softening market doesn't destroy a bull cycle. It resets it. And reset phases are where disciplined buyers make their best entries. But let's be blunt. This isn't a fairy tale. Heraeus isn't projecting doom, and they're not projecting a straight line up either. They're doing something analysts do. They're looking at displacement between fundamentals and price. When prices run too far ahead of demand, especially in metals with thin liquidity like silver, a correction or consolidation is not a possibility, it's a probability. Silver has been running hot, too hot. Anyone who follows this market for more than a season knows silver doesn't move gently. It erupts, overshoots, then cools off. The same pattern has repeated for decades. Heraeus is simply naming the pattern out loud instead of dressing it in hype. Gold, on the other hand, sits on a stronger foundation because central banks keep buying even when private demand weakens. Silver lacks that anchor. Silver relies on industrial demand, speculative demand, and liquidity conditions, three variables that swing hard when prices spike. So, the warning from Heraeus isn't a sell everything signal. It's a reminder that volatility is built into the structure of silver. And when momentum gets ahead of fundamentals, gravity kicks in. In this part, we've set the stage. A major bullion manufacturer with decades of data and a global footprint is telling us that the market may need to cool off before it resumes. That's not bearish psychology. That's market mechanics. Heraeus didn't issue a warning because they feel bearish. They issued it because several measurable drivers are misaligned with current prices. This part cuts through the surface narrative and focuses on the mechanics behind their outlook. The first driver is investment demand versus physical flows. Gold has been pushed higher not only by investment appetite, but by physical metal moving into the US market, tightening liquidity. When liquidity tightens, prices rise faster than fundamentals justify. Heraeus is basically saying the rally has outpaced the structure that normally supports it. That doesn't mean gold collapses. It means the market needs a period to normalize. Silver is even more exposed because it lacks gold's central bank floor. Gold has a consistent buyer that absorbs weakness. Silver doesn't. Silver rides industrial demand, speculative demand, and liquidity conditions. All three swing violently when prices spike. It's a high beta metal, which means it amplifies whatever macro forces are nearby. Heraeus also points to fiscal dominance and central bank behavior. If governments lean on monetary policy to keep borrowing costs low, inflation remains sticky, and real interest rates fall, gold benefits. Silver may follow gold higher, but it doesn't enjoy the same structural support. That creates a split. Gold stabilizes, silver oscillates. Then comes the industrial side, where Heraeus argues demand softens as prices rise. They're not saying factories stop using silver. They're saying substitutions, thrifting, and efficiency improvements accelerate when silver becomes expensive. Industries adapt quickly when a material gains cost pressure. Silver isn't copper or steel. It's a high-value input, so even small cost changes activate substitution. You might disagree with parts of this, and that's fair. But the mechanism is real. Higher prices incentivize technological adjustments. Photovoltaics, electronics, and jewelry all show this pattern historically. Another factor is market structure and volatility. Silver's rally has been fueled by thin liquidity, the London squeeze, COMEX disruptions, and ETF inflows. Thin markets exaggerate direction. Heraeus recognizes that when liquidity normalizes, the exaggeration disappears. That doesn't invalidate the bull case. It removes the artificial acceleration. Finally, Heraeus highlights the probability of a consolidation phase. Not because the bull cycle ends, but because the market cannot digest such a rapid move without a pause. Consolidation is not a bearish verdict. It's a mechanical response. In short, Heraeus expects prices to cool because prices rose too fast relative to the fundamentals that support them. Silver, being more volatile and less anchored, is more vulnerable. Heraeus is not warning because they enjoy pessimism. They warn because the rally in gold and silver has been built on momentum, not structure. When prices rise far faster than the underlying demand can justify, the market always reaches a point where enthusiasm outpaces fundamentals. That is exactly what happened here. Gold broke records, silver exploded, and even platinum group metals jumped to multi-year highs. When moves happen this quickly, the market doesn't collapse. It stalls. And stall periods always look like consolidation, which is just a polite word for the market catching its breath. Heraeus's analysts point out something obvious but uncomfortable. The rally became too hot, too fast. You don't need a PhD to see it. Price acceleration outpaced physical flows. And when physical supply cannot keep up with financial demand, liquidity gets tight. That is what caused the earlier squeeze. Metal moved from London to New York, leases spiked, and prices printed a new nominal high. That kind of squeeze does not repeat often. Once it burns out, the market needs time to digest the gains. The warning about early 2026 weakness is therefore not a bearish call. It is a structural observation. After a massive run, assets often retrace or move sideways before the next leg. You saw it in gold this year. Months of sideways movement before the breakout. Silver has been even more extreme because it has a higher beta, meaning it amplifies moves and amplifies corrections. Heraeus also separates gold from silver in a way many analysts miss. Gold has a firm floor because central banks keep buying. They might buy slightly less than the record years, but they still buy. This creates a structural bid that silver simply does not have. Silver relies on industrial demand, and industrial demand is fragile when prices spike. High prices destroy demand. This is basic economics. When silver hits record levels, jewelry buyers step back, industrial buyers look for substitutions, and recycling increases. That weakens the demand side, even while investment demand remains strong. This is why Heraeus expects gold to remain resilient even during a pullback, while silver remains exposed. Silver's demand mix is unstable. Gold's is sticky. That distinction matters because it tells you where the real risk lies when momentum fades. And the picture gets even more complicated when you add macro risk, a possible recession, a flattening yield curve, and political pressure on the Fed. Weak growth undermines industrial demand, and silver feels that first. Heraeus's warning only becomes dangerous if several macro pieces line up at the same time. And right now, those pieces are not fantasy. They are visible. The US yield curve inverted for more than a year, then uninverted. Historically, that sequence usually precedes recession. Not immediately, but within a predictable window. If a recession lands in 2026, the entire precious metals complex faces downward pressure, because risk assets delever and industrial metals suffer first. Silver is the most exposed in that scenario. Its industrial demand weakens when economic growth slows, and its investment demand cannot fully compensate because silver investors are more price sensitive than gold investors. If the Fed pauses rate cuts or delays easing, real yields stay elevated, which is fundamentally bearish for both metals. Gold might soften, but silver will react violently. Horaeus also highlights a risk that many analysts overlook: tariff uncertainty on platinum group metals and Russian imports. That uncertainty injects volatility into the supply chain. When supply becomes uncertain, prices spike, then collapse, then spike again. Volatility is not a bullish signal. It is a sign of instability. Markets hate instability. Then there is the political variable. If fiscal dominance strengthens, meaning the government pressures the central bank to keep rates low to manage debt, inflation remains sticky. Sticky inflation is usually good for gold because it pushes real rates lower. But it is not uniformly good for silver because silver's industrial demand weakens in inflationary slowdowns. Horaeus essentially says gold has a floor because central banks keep buying. Silver does not have that same floor because its demand mix is fragile. If a recession hits, both metals correct, but silver corrects harder. If rates stay high, corrections extend. If rates fall, gold stabilizes quickly. Silver lags. This creates a situation where consolidation is almost guaranteed, and a deeper pullback is possible if macro conditions deteriorate. In other words, the market is not weak, it is overextended. Overextension doesn't crash, it retraces. And retracement is where opportunity and risk coexist. Silver and gold have been running on pure momentum, and Horaeus is basically saying the party has gone too far, too fast. That isn't a prediction, it's a structural observation. When an asset doubles in a year, when liquidity disappears, when ETF inflows spike and physical markets tighten, the risk profile changes. You don't need a PhD to see that. You just need to understand market mechanics. A rally that accelerates this quickly creates its own fragility. Horaeus is warning that the first half of 2026 could soften because the market has already priced in most of the bullish drivers. And they're not wrong about the mechanics. When prices outrun fundamentals, consolidation becomes unavoidable. But here's where you need to think critically, not just accept the headline. They assume demand will weaken because prices are too high. That sounds logical until you realize silver demand in most industrial applications is in grams, not kilograms. A solar panel uses a tiny fraction of silver relative to the cost structure, and most manufacturers won't abandon silver unless a replacement is dramatically cheaper or technologically superior. High prices suppress demand is a lazy assumption unless you actually quantify the elasticity. Horaeus never does. They also expect investment demand to stay strong while physical industrial demand slows. That creates a contradiction. Investment demand is the most price-sensitive component, and it's also the component that has been driving the entire rally. If investment demand remains robust and central banks are still buying, then the downside pressure they expect simply doesn't materialize in the way their report implies. Another flaw. They frame the bull market as excessively enthusiastic, which is a polite way of saying prices moved faster than our models expected. Models fail when liquidity regimes break down, which is exactly what happened when London liquidity vanished and the metal migrated to New York. You can't treat that as a normal cycle. It's a structural shift, and structural shifts don't reverse neatly. They also lean heavily on recession risk. Yes, recessions usually pressure commodities, but gold and silver do not behave like copper or oil. in a recession with negative real rates, which is exactly what their own macro scenario implies, precious metals benefit, not suffer. You cannot call for a slowdown and simultaneously expect metals to collapse when the monetary environment becomes more inflationary. So the warning is half accurate, half oversimplified. There will be a pullback at some point because vertical moves always correct. But the idea that a prolonged decline is likely ignores the deeper drivers: central banks, de-dollarization, investment demand, and structural tightness in supply. And those drivers don't disappear just because the chart looks extended. Step back from the noise and the conflicting commentary. The market has already done something extraordinary. Silver has exploded, gold has followed, and the entire complex has been pushed by a mix of physical tightness, investment demand, and structural shifts in liquidity. That combination does not unwind neatly. It creates a regime change, not a temporary spike. Horaeus is correct about one thing. After a vertical move, a correction is unavoidable. Markets do not move in straight lines, and silver especially has a habit of overshooting and then bleeding back. Anyone pretending otherwise is either naive or selling something. A pullback is a feature, not a flaw. But the mistake in their narrative is assuming that a pullback automatically implies a bearish cycle. That assumption ignores the deeper forces still sitting underneath prices. Central banks continue to buy. De-dollarization is not slowing. Physical supply remains tight, particularly in the West. And investment demand, the most price-sensitive component, has not actually cracked. When the supposed weakness drivers, high prices, industrial demand, recession risk, collide with the strength drivers, real rate pressure, safe haven demand, structural scarcity, the balance tips toward resilience rather than collapse. What you should internalize here is this: silver is volatile, but it is volatile inside a bullish framework. Corrections happen, but they are corrective, not destructive. They reset excesses, but they do not erase the underlying trend. If 2026 brings a slowdown or a dip, it will not invalidate the bull market. It will simply offer a lower entry point inside the same macro structure. And if inflation remains sticky and real rates stay suppressed, the dip could be shallow and short-lived. Gold will remain the anchor because central banks keep accumulating it. And silver, being the higher beta metal, will amplify whichever direction gold sets. That is the honest reality. Silver magnifies gold's moves, both up and down. Anyone expecting a gentle linear path has not understood how this market functions. So the real message is not prices will fall or prices will rise. The real message is volatility is coming, but the structural trend remains intact. Corrections are opportunities, not signals of collapse. And that is exactly why you don't panic when charts get stretched. You think in cycles, not moments. You've been listening to a clear-eyed look at the metals market. No hype, no fantasy, just the mechanics and the risks laid bare. Silver is moving fast, gold is steady, and the forces underneath both remain powerful. Stay informed, stay analytical, and keep your core stack disciplined. This is Gold Rush Reporter, bringing you precision, not noise. Until next time.